When we look at financial accounting, there are four basic financial statements. Let's take a minute and look at the balance sheet. Now the balance sheet, what it really does is it explains what the business owns and what it owes. So what you own and what you owe. Now, one thing to notice about the balance sheet is it really is only at a very particular point in time. So this does not cover an entire month. It does not cover an entire year. What it really does is it explains what the assets and liabilities and also owner's equity, as we'll see in a few minutes, it explains what those amounts are at this very particular point in time. On New Year's Eve, December 31, 2017, these were the assets and liabilities of this particular company. Now, obviously, I think some of these are very familiar to you. If you take a look at cash, for example. You've come this far in life, you know what cash is. But it goes beyond just the dollar bills and the other currency in your wallet. It's checking accounts, savings accounts, money market accounts, things like that, that certainly are resources of a business. Then we take a look at inventory. Inventory, another asset, another thing that the company owns. Now, inventory is really stuff that is held for resale. It's going to be sold to customers. Now, as you take a look at this, you also can see down here a couple of assets I've included. Buildings and equipment. Those are also resources of the company, things that it owns, but these are more long-term in nature. You're probably watching this video in a building on a piece of computer equipment. You can kind of make the analogy that businesses would also have these types of resources available. Now, what I'd like to point out here is that we have a classified balance sheet. And what that means, if you take a look at this first couple of assets here, total current assets. Current assets are those that are either already cash, or they are expected to become cash, or be used up within the next operating cycle or within the next 12 months. Very commonly conceived, the next 12 months is often the litmus test here. So in other words, think about that 12-month time frame. Cash is already there. We hope that inventory will become cash within the next 12 months. What we have to do with that inventory is sell it to our customers, hopefully at a markup with a profit, and then that will become cash. Now, the buildings and equipment, obviously you could sell buildings and equipment, but most businesses don't do that on a regular basis because if you start to sell all of your infrastructure, you'll no longer have something with which to run your business. So buildings, equipment, and other long-term assets, those are not expected to be converted to cash or used up within the next year or the next operating cycle. What this lets us do is assess the liquidity of a company. If we know that current assets are expected to be converted to cash or used up within the next year, then we can also, and we'll see this in just a minute, we can also compare that to the current liabilities or the amounts that the company expects to have to pay within the next year. And that's one of the ways that we can assess the short-term health of the entity. In a minute, what we'll do is we'll flip over to the other side of the balance sheet and we will look at the liabilities and the owner's equity. So continuing with the balance sheet, and remember, this is the assets and the liabilities. In other words, what does the company own and what does it owe? So on the second page of the balance sheet, or the second half of the balance sheet, what we do is we have liabilities and stockholders' equity. Now, as a reminder, there is this basic accounting equation that we have. Assets equal liabilities plus stockholders' equity. Sometimes I like to refer to it as assets equal liabilities plus owner's equity, simply because stockholders' equity refers specifically to a corporation because stockholders own shares of a corporation. Owner's equity is a more broad term because an entity might be organized as a corporation, but it also could be a LLC, a limited liability company. It could be a partnership. It could simply be a sole proprietorship. So when I say owner's equity, I'm simply referring to corporations and LLCs and partnerships, so very broadly. But let's take a look at this second part of the balance sheet. So we have current liabilities and non-current liabilities. If you remember from our discussion with assets, current assets are expected to be converted to cash or used up, consumed within the next year. Now, current liabilities, what we have, you can take a look, we've got this $30,000 here. We would expect to have to satisfy these current liabilities within the next year. So accounts payable, what that really represents is amounts that we owe to our vendors and our suppliers. So we bought some inventory, maybe a company provided a service to us. We didn't pay for it yet, but we will have to pay for it soon. Sales tax payable, retailers, restaurants, other companies that need to collect sales tax on behalf of the state where they're organized or where they're doing business, well, they're simply an agent. So if a retailer collects 6% sales tax from its customers, that money really does not belong to the retailer. The retailer is holding on to it for a very short period of time, but eventually they have to pay this to the state of Michigan or whatever state treasury really has the right to receive that sales tax, those sales tax dollars. So what we're seeing here, and obviously this example is very, it's a very compact, summarized example, but I just want to get the key points out. So what we're seeing is that within the next 12 months, this $30,000 is going to have to be paid. So what we can do is we can compare that with the current assets, and that's one way to assess the short-term health of the company. What do the current assets look like relative to the current liabilities? In fact, we'll explore this in more detail later, but there's something called the current ratio. Current ratio being current assets divided by current liabilities. We can look at the magnitude of their relationship. Also, there's something called working capital that we can assess. Current assets minus current liabilities. With both of these, bigger is better. A bigger current ratio is safer, stronger, more healthy in the short run. Larger working capital also indicates the ability for a company to stay alive within the next 12 months. Now, just like there were current assets and non-current assets, there are also non-current liabilities. We've only included one in this particular example, so it's this $370,000. And what we're seeing there is that this is debt that is owed beyond the next 12 months. So a long-term note payable, perhaps some kind of a mortgage, could be bonds payable. But what that's really telling us is, yeah, the company owes this money and it will have to satisfy these obligations, but not within the 12-month period after the balance sheet. So what we're really looking at there is solvency. When we're looking at long-term liabilities and long-term assets, we're trying to measure solvency. Solvency is the long-term health of the company. Now finally, referring back to this basic accounting equation, which the balance sheet is essentially the accounting equation in the format of a report, we have stockholders' equity down here. Now, stockholders' equity, I'm keeping it pretty simple for you here. We have common stock and retained earnings. The reality is the stockholders' equity section of the balance sheet really has the potential to have more complication. There can be different classes of stock, such as common stock and preferred stock. We can see things like additional paid-in capital or even treasury stock. So there are things that we will explore at a later date, but for now, let's just keep it simple. Common stock and retained earnings. Common stock is what we call contributed capital. So what that means is these are really the dollars that the owners have contributed to the business. Okay? Contributed capital. And so when owners have purchased stock, shares of stock in the company, they have essentially contributed this money to the corporation. So the common stock is money that the owners have put in. Retained earnings, on the other hand, is a little bit of a different animal. Retained earnings is not contributed by the owners. It actually results from running the business profitably. So the way to think about this is that earnings are analogous to net income. And so retained earnings comes from generating profitable sales with customers, but not paying those out to the owners in the form of dividends. You see, one of the ways that you can be rewarded as a corporate owner is to receive a dividend. If there have been sufficient income over the years, if there's sufficient retained earnings, and if the company has a sufficient cash balance, then what can happen is the corporation could declare a dividend. If that happens, that dividend is going to come out of retained earnings. So retained earnings is really the source for any dividends that a company would pay. So what we're seeing in this case, the company has $100,000 of retained earnings. That means that's $100,000 of profit since over the life of the company, since its inception. $100,000 of profit generated and not taken out as dividends by the owners of the company. Now, you might remember that total assets were $550,000. Guess what? Total liabilities plus total stockholders' equity also equals $550,000. It's called a balance sheet. That's how it balances, if assets equal liabilities plus stockholders' equity.